Hello everyone, this is Knowledge Topper, and in this video we are talking about types of audits. I already made a video regarding what is an auditing, and we talk about auditing in a brief manner, and definition of audit I also cover that in previous video. So do watch that video if you want a starting insight of auditing. Okay, so let's start it. We are talking about types of audit. So there are three types of audits. Number one is external audit, then we have internal audits, and the third is internal revenue service, means IRS audits. Okay, so we are talking about these three audits. So let's get into this video. So first of all, we start with external audits. Like, external audits are commonly performed by certified public accounting CPA firms and results in an auditor's opinion, which is included in the audit report. Okay, so an unqualified, you can say there are different types of opinion and an external auditor gives. So if you want to watch the audit opinions video, I already made that, like what is the opinion that an auditor gives in different circumstances, in our modification to the auditor's opinion video that I already made. So do watch that. I make a link here, I attach a link here, so you can click on that and go to watch that particular video. So out of four opinions, there are one opinion like in which an auditor shows that the financial statement are not having any misstatements, and it represents a true and fair view of the financial statement. So it is called an unqualified opinion, or can say clean audit opinion, in which an auditor has not identified any material misstatement as a result of his or her review of the financial statement. So external audits can include a review of both financial statement and the company's internal controls. So there are some benefits that relate to external audits, like audits performed by outside parties like external auditor can be extremely helpful in removing any bias in reviewing the state of a company's financials. Financial audit seeks to identify if there are any material misstatement in the financial statements, and I already told you that an unqualified or clean auditor's opinion provides the financial statement users with confidence that the financials are both accurate and complete. So external audits therefore allow stakeholders to make better, more informed decisions related to the companies being audited, and that is what we learn in external audits. So the second is internal audits. Now if we talk about internal audits, so internal audits serve as a managerial tool to make improvement to processes and internal controls. So internal auditors are the employees by the company, or they are employed by the company, and you can say organization for whom they are performing an audit, and the resulting audit report is given directly to the management and the board of directors. So there are consultant auditors as well, while not employed internally. So in internal audits, they use the standards of the company, and they are auditing as opposed to a separate set of standards. So these types of auditors are used when an organization doesn't have the in-house resources to audit certain parts of their own operation. Like the result of the internal audit are used to make managerial changes and improvements to internal controls. The main purpose of an internal audit is to ensure compliance with laws and regulation, and to help maintain accurate and timely financial reporting, and also data collection as well. So it also provides a benefit, you can say, that to management by identifying flaws in internal controls of financial reporting prior to its review by external auditors. So this is the best thing about internal audit, that it helps in identifying flaws in internal controls and helps management to improve. So the third type is internal revenue service, IRS audits. They used to verify the accuracy of a taxpayer's return and specific transaction. Like if you talk about this definition, like the Internal Revenue Services, IRS, also routinely performs audits to verify the accuracy of a taxpayer returns and specific transactions. So when the IRS audits a person, or you can say a company, it usually carries a negative connotation about a company or individual person, and is seen as evidence of some type of wrongdoing by the taxpayer. However, you can say that being selected for an audit does not necessarily means or indicate that a company or an individual is involving in any wrongdoing. So IRS, you can say Internal Revenue Service, audit selection is usually made by random statistical formulas, and they analyze a taxpayer return and compare it to similar returns to check that particular information. A taxpayer may also be selected for an audit if they have any dealings with another person or company who was found to have tax errors on their audit. So these are the three types of audit. Hope you understand. Hope it works for you. Hope it helps you a lot. So this is the video for you guys. Do subscribe our channel Knowledge Topper if you like this video and want more good stuff like that, and also like our Facebook page. So thank you so much everyone. It is the time to say bye bye to you all. Thank you so much everyone.